Hello, my name is Sukanya Lord. This is a presentation on sensitivity analysis for capital budgeting and how this impacts decisions within our HVAC company. Capital budgeting involves long-term investment decisions that require significant capital commitment and expose the firm to operational and financial risk. As Irons explains, capital budgeting decisions directly influence long-term firm value and must be evaluated using disciplined financial frameworks. In the HVAC industry, investments such as fleet expansion, diagnostic technology upgrades, or new service lines create both opportunity and risk. Sensitivity analysis improves capital allocation decisions by systematically integrating risk into project evaluation, rather than relying solely on deterministic projections. The primary objective of financial management is to maximize firm value while balancing profitability, liquidity, and risk exposure. This objective is executed through investment decisions, financing decisions, working capital management, dividend and distribution policy. Capital budgeting decisions evaluate investments using net present value or NPV and related metrics. Financing decisions determine the firm's cost of capital, which becomes the method for evaluating projects. Working capital management ensures sufficient liquidity to manage seasonal fluctuations common in HVAC operations. Together, these functions provide the strategic foundation for disciplined capital allocation for dividend distribution decisions. Quantitative sensitivity analysis begins with a base case NPV model built from projected cash flows and an appropriate discount rate. The structured process includes establishing baseline assumptions. As Irons emphasizes, net present value, or NPV, is preferred because it measures value creation after accounting for time value of money. Identifying key financial drivers, varying one input at a time, recalculating NPV, ranking impact magnitude, determining break-even thresholds. As Kalber explains, sensitivity analysis isolates how changes in critical inputs influence financial outcomes and identifies which assumptions most significantly drive project value. Ranking these variables allows management to focus on the most influential risk factors. Quantitative modeling must be complemented by qualitative evaluation. Key qualitative considerations include operational feasibility, labor availability, regulatory exposure, vendor reliability, and strategic alignment. As Irons notes, capital budgeting decisions must incorporate operational and strategic realities that extend beyond financial projections. For example, a new service offering may appear financially viable. However, if qualified technicians are unavailable, projected revenue assumptions may fail. Qualitative analysis explains why certain quantitative sensitivities exist and how management can prepare mitigation strategies. Both dimensions are essential for robust capital budgeting. Sensitivity analysis requires disciplined critique. We must identify fragile assumptions, evaluate concentration risk, test downside resilience, and avoid base case overconfidence. If a project becomes unprofitable with a modest decline in service demand, it indicates exposure to demand volatility. This strengthens decision quality by revealing where mitigation strategies are necessary. Sensitivity analysis transforms capital budgeting from static projection into structured risk evaluation. Internal financial methods embed company-specific risks into capital budgeting. These include historical job performance data, operating leverage analysis, working capital stress testing aid, and risk-adjusted discount rates. As Irons explains, higher risk investments require higher expected returns to justify capital allocation. Stress testing working capital ensures liquidity remains sufficient during seasonal demand shifts. Internalizing lessons learned ensures that budgeting decisions reflect needs in our HVAC company. External financial methods incorporate broader market risk into investment evaluation. The Capital Asset Pricing Model, or CAPM, estimates cost of equity. KE equals RF plus beta times the market risk premium, where KE is the cost of equity or the expected return. RF is the risk-free rate, and beta is the systematic risk or sensitivity to the market, as described by Dahlquist and Knight. The weighted average cost of capital, or WACC, blends debt and equity costs. WACC is the sum of equity divided by total value times the cost of equity and the debt divided by total value times the cost of debt times 1 minus the corporate tax rate. Un and Resnick, as well as Stolz, emphasizes that cost of capital must reflect systematic risk exposure when evaluating investment decisions. External considerations also include credit market conditions, industry demand volatility, Integrating both internal and external risk ensures that capital budgeting decisions remain resilient under realistic variation. In conclusion, sensitivity analysis strengthens capital budgeting by distinguishing quantitative and qualitative risk factors, embedding internal operational data into projections, integrating external market risk into discount rates, critiquing fragile assumptions, validating project resilience before capital commitment. For our HVAC company, this disciplined framework protects firm value, preserves liquidity, and enhances long-term financial stability. Sensitivity analysis is not merely a calculation technique, it is a structured approach to responsible capital allocation. Please see my list of references here, as used within my presentation. Thank you very much for your attention.